All right. So we've gone over demand and we've gone over supply. And most of you probably already know that the price is where the demand curve and the supply curve intersect, which is called the equilibrium price. But you probably have never wondered what makes that price the equilibrium price, who determines the price, or why it's even called the equilibrium price in the first place. Well, that's what we're going to talk about today, and I'll explain why the equilibrium price is the best price for the entire society.
First off, let's look at the definition. Market equilibrium occurs when the quantity supplied equals the quantity demanded. At this point, the price is called the equilibrium price, and the quantity is called the equilibrium quantity. In other words, the buyers bought what they wanted and the sellers sold what they wanted. Everyone is happy. But let's take a deeper look at why that is. Imagine you go to a market to do some shopping, but there are no fixed prices at this market, so you're going to have to bargain. You find a rubber chicken you like and ask the seller how much. But he asks you, how much would you like to pay? Let the bargaining begin. Now, to start the bargaining, should you start with a high price or a low price? Well, of course, you should start at a low price. So, on the demand curve, you'll start way over here. And how about the seller? Do you think he's also going to start with a low price? Of course not. He's going to open with a ridiculously high price. So, on the supply curve, he'll be over here. As the bargaining continues, you will keep offering a higher and higher price, and the seller will keep offering a lower and lower price, until you make a deal and agree on a price that you're both happy with. Now, of course, in this example, the bargaining is between just one buyer and one seller. But a very similar thing happens on a larger scale for the entire market. Let's look at it another way. Remember, nothing is actually happening on the right side of our diagram because the price the seller wants is too high for what the buyer wants to pay. So, no transaction will occur. As a matter of fact, we can use the equilibrium price to split the curves into two parts each. We can divide the demand curve into buyers and non-buyers. The non-buyers over here are the customers who are not willing or able to pay the equilibrium price. And for the supply curve, we can divide into suppliers and non-suppliers. Over here are the non-suppliers because they were offering a price that was higher than what any consumer is willing to pay. So if you think of it in this way, you'll see that the product is bought by the customers that value it most, since they are willing to pay the most. And the products are made by the most efficient firms, those with the lowest production costs, because they can afford to sell at the lowest prices. That's the free market at work. Now you can begin to see why that might be good for society. It minimizes waste. If resources go to the ones that value them most, they are less likely to be wasted. Think about the things that are valuable to you. Whatever those may be, I'm guessing you probably are very careful with them and try to make sure they last a long time, right? And on the supply side, a firm that aims to reduce costs so they can offer a lower price will do so by running their production as efficiently as possible, by minimizing wasted resources. If a firm can't reduce costs, then their price will be too high for consumers. They won't make any money, and they will soon go out of business, meaning only the efficient firms will survive. So the next time you want your parents to buy you a new phone, you can explain how markets benefit society, and tell them how buying you a new phone helps make the world a better place. Now, let's look at the left side of the diagram, because that's where all the action is, since the right side is where the non-buyers and non-suppliers hang out. Remember, the demand curve shows us the price people are willing and able to pay. As you can see, the demand curve here is showing us that some people are willing and able to pay $100, but they don't have to pay $100 because the market price is $50. So how do you think they feel? The same way you feel when you buy something for much cheaper than it usually is. Pretty darn good. And in economics,
Oh,
we can
yes.
actually measure how happy this makes you by measuring the area below the demand curve and above the price. Or, in another way, the area that shows us what the consumer would have paid and what they actually paid. This area is called the consumer surplus. HL students will need to know how to calculate that, which is really easy because it's just the area of the triangle, but we'll go over that at the end of the video. For the SL students, you just need to be able to identify it and know what it represents. Okay, back to consumer surplus. First of all, it's a bit confusing because of the word surplus, which means extra. Let me try to explain why we use that word. Remember in Unit 2.1 how I said you could think of the demand curve as a benefits curve? Well, you can think of consumer surplus as the benefits surplus. It shows the extra benefit the consumer received by paying a cheaper price than they wanted to. And then you can do the same for the suppliers. You had some suppliers that were willing to supply at a very cheap price, only $10, but they didn't have to. Instead, they could sell for $50. They're going to make a lot more money, so of course they're happy. And their happiness is called producer surplus, and it's the area above the supply curve and below the price. Or, in another way, the difference between the price they sold at and the price they would have accepted. And so it's a surplus for the producers as well, since they are making additional money that they otherwise wouldn't have made.
And since everyone in a society is either a consumer or a producer, we can add the consumer and producer surpluses together and get the total benefit to society, which is called the total social surplus. So, as you can see, the equilibrium price is when the total social surplus is maximized, meaning the greatest number of people are happy. Look what happens if we don't get to equilibrium. Let's say the price and quantity are here. In later videos, we'll learn what might prevent the market from reaching equilibrium, but for now, you don't need to know why it happens, only that it results in a loss of potential benefits. So social surplus is not maximized. But you might think, well, what if we move past equilibrium? Would that result in even more benefits? No, but that's a good question. Let's check out what happens if we move past the equilibrium supply. Let's say the producers have made too many rubber chickens. And because of increasing marginal costs and the law of diminishing returns, they need a price of at least $70 to cover their costs of producing the 7th rubber chicken. But the consumers are only willing to pay $30 for that 7th chicken due to the law of diminishing marginal benefits. That 7th chicken just isn't as funny as the first, so the consumer wants a cheaper price. In other words, the producer just wasted time, money, and other resources to produce a product that nobody will buy. And because of that, this area of the diagram represents waste. This is when society's resources are not being used efficiently to give the people what they want. In economics, we call this allocative inefficiency. And so again, this is why the equilibrium price and quantity are best for society. It's because society's resources are being used in the best possible way to produce the things that the people want most, aka allocative efficiency. In economics, we define allocative efficiency as the point where marginal benefits equals marginal costs. Remember how I said that you can think of the demand curve as a benefits curve and the supply curve as a cost curve. So allocative efficiency occurs where these two curves intersect, which is at the equilibrium point. But let's take a closer look at why it is. If the marginal costs are greater than the marginal benefits, this would mean that it is costing society more precious resources to produce the last unit than the value that society puts on it. In other words, suppliers are wasting resources making more than what the people actually want. If marginal benefits are greater than marginal costs, this would mean that society places a greater value on the last unit produced than the cost to produce it.
In other words, the people are not getting enough of what they want or need, so society is losing out. However, if marginal costs are equal to marginal benefits, this means that society has allocated the right amount of resources to produce the quantity of goods that its people value the most. This is allocative efficiency, and this is why it occurs at the point of market equilibrium.
Okay, let's go back to rubber chickens. Our producers have made too many rubber chickens. In economics, this is called excess supply, or a surplus. But don't get this confused with consumer and producer surplus. This surplus is bad. It means that there has been wasted resources. So what do you think they'll do with the extra rubber chickens? Just throw them away? No way. They'll still try to make some money from them. Even if they sell them below marginal cost, at least they'll make some revenue back compared to throwing them away and making no money at all. So what's going to happen is the producers will begin dropping the price. But again, they still want to make as much money as possible, so they'll only drop the price down to the highest possible price that the consumer is willing to pay, which will again be the equilibrium price. Now let's take a look at a market that can't get enough rubber chickens. That would be excess demand, and this is called a shortage. It occurs when the consumers demand more than what the supplier can produce. A shortage is going to occur below the equilibrium price. Let's say suppliers are producing 3 rubber chickens, but the people want 7. What do you think will happen to the price? That's right, the price is going to increase to the highest possible price that the consumers are willing to buy, which, again, will be the equilibrium price. What you're seeing at work here is the invisible hand that Adam Smith was talking about. When there's a surplus in the market, there will be a downward pressure on the price, and the invisible hand will pull the price back down to equilibrium. The exact opposite happens during a shortage. There will be an upward pressure, and the invisible hand will push the price back up to equilibrium. This is why we call it equilibrium in the first place. You may recall from your chemistry class, and if you're taking IB chemistry, then good luck, you'll need it, that equilibrium occurs when opposing forces are balanced. So that's exactly what is happening in the market. The price will get pushed or pulled until it reaches equilibrium, where the forces disappear completely and the two sides even out. At the equilibrium, there is no longer any pressure on the price since both the consumers and the supplier are happy.
Next up, we need to talk about a core concept in economics called the price mechanism. You might not think about it this way, but a price is essentially measuring how much you want something. Remember the guy in the desert from Unit 1? He's willing to pay a very high price because of how much he wants the bottle of water. But try to imagine a world without prices. What if everything was given to you for free? Sounds pretty amazing at first, right? But let's take a closer look. Let's say you got free food from the government. So every week they gave you a box of food. In the box, you got some food you like, let's say pizza, and some food you don't like, let's say sardines. You hate sardines, so you just throw it away. I mean, it's free, right? So who cares? But because you don't buy it, the government doesn't know that you don't like sardines. So every week, they just keep giving you more and more sardines. Think about how wasteful that would be. Instead of sardines, you wish you could have more pizza. But resources are being used to produce sardines, when they could be used for something people actually want. In this way, prices are how people in a society vote on what they want. And your vote acts as a signal to suppliers and tells them what they should produce. The products that get the most votes are the ones that get produced more, and the products that get less votes get produced less. This is the price mechanism. It is the mechanism that moves the invisible hand of the market. Let's talk about how it works.
The price mechanism works through several functions. First, it gives signals to both producers and consumers. Let's say you have a t-shirt business. You notice that for some reason, your customers buy a lot more blue t-shirts than red t-shirts. You sell all your blue shirts very quickly, but almost no one buys your red shirts. In other words, you have a shortage of blue shirts. This will signal to you to raise the price of your blue shirts because the customers value blue shirts more. On the other hand, you have a surplus of red shirts, which signals to you to lower the price of red t-shirts because customers value them less. This is called the signal effect. But on the consumer side, the price mechanism also sends signals to the buyers. As the price of the blue shirts increase, so does the opportunity cost. I mean, yeah, maybe you prefer the color blue over the color red, but how much are you willing to pay for it? As the price increases, the preference for blue will matter less and less. If it gets too expensive, then you would rather spend your money on something else. So the rising prices signal to the consumer that there is a rising opportunity cost, and the consumers will want the good less and less as the price increases more and more. And as the price decreases, this signals to the consumer that there is a decreasing opportunity cost, meaning that they will want more. Again, this is the signaling effect of the price mechanism. There's also an incentive effect of the price mechanism. From the price, producers are incentivized to listen to the people and produce what they want as efficiently as possible. Doing so will reward the producers the highest possible profit. So, a good with a rising price will incentivize a firm to produce more. But a good with a falling price will incentivize a firm to cut their losses and produce less. Both are done in an effort to maximize profit. For consumers, there's an incentive effect from the price as well. If the price of a good increases, it incentivizes you to consume less of it. And if it decreases, it may incentivize you to consume more. Think about electricity, for example. Most of you probably don't pay your electric bill at home. So, during the summertime, you probably jack up your AC to a nice frosty level. Might not even see a problem with having the door or window open at the same time. But then your dad comes home and yells at you. Why? Because he's the one paying for it. It's free for you, so you happily consume more. But he has to pay for it, so the higher price incentivizes him to consume less. The signaling and incentivizing effect work together to have a reallocation function on the market. As we already learned, as the price rises, suppliers will produce more, right? In other words, the rising prices signal to the producers what the people want, and the producers will reallocate resources away from the goods the people don't want and toward the goods they do want. This minimizes wasted resources, and allocative efficiency is achieved to give the people what and how much they want. Remember the basic economic questions from Unit 1? The allocation function answers the first two questions, what and how much to produce and how to produce.
The price mechanism also offers a rationing function to society. The rationing function answers the third basic economic question, for whom to produce. In other words, who gets the product? Again, imagine if there were no prices and everything was given for free. The economy might be supplying people with more things they don't want and less things they do want. That would be extremely wasteful. But then, how should goods be distributed? First come, first serve? Should they be given to the important people in society first, since they provide more benefit to society? There's no perfect answer here, but in a free market economy, the products go to the ones that are willing to pay the highest price. Imagine if there was only one unit available. Who would the producer sell it to? Obviously, they would sell it to the highest buyer. Of course, this is going to favor the rich, and maybe this isn't totally fair, but in this way, goods are distributed to the ones that value the most, determined by who is willing to pay the most. That's the rationing effect. Hopefully, you can start to see how signals, incentives, and rationing in combination work together to form a competitive market. The price mechanism works to find the highest paying buyer and the lowest selling producer. This is why it's called a competitive market. Buyers are competing against other buyers for goods by offering higher prices. and sellers are competing against other sellers by offering lower prices, which is done by minimizing costs. This competition ensures that society gets what they want with minimal waste. It's actually pretty amazing how it all works.
Okay, guys, we're almost done, I promise. There's one more thing we need to talk about, and it should be pretty easy if you watch the previous videos on demand and supply. As you learn from those videos, there's a difference between a shift in quantity demanded or supplied and a shift of the entire supply or demand curve itself. Remember that a shift of the curve itself is caused by a factor other than the price. A change in price is only going to cause a movement along the existing curve. So far in this video, all we have talked about is how a change in price would affect the market equilibrium. Now let's talk about what would happen if there's a non-price determinant that causes a change in supply or demand and the entire curve shifts. Well, it's pretty easy. So an increase in demand is going to shift the demand curve to the right. So this is going to move the equilibrium to a new point higher up on the supply curve. This means that equilibrium is now a higher price and a higher quantity. That's pretty easy to see on a diagram, but let's talk about why that happens in the real world. So on this diagram, as the demand curve shifts rightward to D2, you can see from the original price, P1, that now the quantity demanded at P1 has increased from Q1 to Q2. In other words, there's now an increase in demand at that price. The excess demand causes a shortage that can be measured as the distance from point A to point B. As we learned earlier, this signals to suppliers that consumers value that good more now, so it will incentivize them to increase the price. So the price moves up to point C, which becomes the new equilibrium point. When supply increases, the supply curve shifts to the right, and obviously the quantity increases. At the original price P1, there is now excess supply, or a surplus, which can be measured by the distance from A to B. This signals to the suppliers that the consumers don't value that good as much, and that will incentivize them to produce less, decreasing the cost of production, which will allow them to decrease the price down to settle at a new equilibrium at point C. So, the excess supply results in a higher equilibrium quantity at a lower equilibrium price. Alrighty, if you're an SL student, you are done. Thanks for making it to the end. If you're an HL student, we've got one more thing to talk about, but it's pretty easy, so let's hurry up and get it over with. HL students will need to be able to calculate consumer and producer surplus from a diagram. If you've been paying attention, you already know what those are and where to locate them on a diagram. So all we need to do is find the area. Most of the time, it's going to be a triangle. So to find the area of a triangle, we use this formula: base times height divided by 2. Let's go back to the rubber chicken market. Now, the demand for rubber chickens has decreased and the demand curve has shifted to the left. Our new equilibrium is now 4 units at $40. Let's try to find the consumer surplus. We know that the consumer surplus is the area below the demand curve but above the price level. So that'll be this area here. Now, let's use the formula to find the area of this triangle. So the base of the triangle will be where the demand curve intersects the price axis, which tells us the highest price a consumer is willing to pay, in this case, $70, minus the actual price, $40. So our base is 30. Now the height is going to be the equilibrium quantity, which is 4 units. So our height is 4. 30 times 4 is 120. Now divide by 2 and we get 60. Since producer and consumer surpluses represent a monetary value that is gained, we express the units with money. So we can say the consumer surplus is $60. Now pause the video and try to see if you can calculate the producer surplus using the same method. Okay, let's see how you did.
For producer surplus, we're looking at the area below the price level, but above the supply curve. So this triangle here. The base is the price, $40, minus the lowest possible price, which in this case is 0. By the way, be careful, because the lowest possible price won't always be 0. Not all diagrams start at 0, so watch out for that. So our base is 40. The height is the equilibrium quantity, 4 units, so our height is 4. 40 times 4 is 160. Divided by 2 is 80. And then, once we know the consumer and producer surpluses, all we need to do is add them together to get the social surplus, which in this case would be 140.
Like I said, most of the time, the shape will be a triangle, but not always. This is a diagram where the supply line doesn't intersect the price axis, which happens sometimes, so I wanted to show you what that looked like. If you notice, you'll see that the shape of the producer surplus has changed. It is no longer a triangle, it's a trapezoid, so we need a new formula. To find the area of a trapezoid, you add the lengths of the two parallel lines together, let's call them A and B, then multiply by the height, let's call that C, and divide by 2. Alright, so this one's a little tricky, so pause the video, take your time, calculate the consumer surplus, the producer surplus, and the social surplus, and we'll see how you go. Okay, let's start with consumer surplus since it's easier. So the highest possible price, $100, minus the actual price, $40, gives us 60 as the base. The height is the equilibrium quantity, which is 6. Multiply that by 60, and we get 360. Divide by 2, and the answer is $180 for the consumer surplus. For the producer surplus, we need to find the area of the trapezoid. So we add A and B together, so that's 2 plus 6, which is 8. Then we multiply that by C, which is the price, $40. This gives us 320. Divide by 2, and we get $160 for the producer surplus. So for the social surplus, we just add the two surpluses together. So that's $180 for the consumer surplus and $160 for the producer surplus to give us a social surplus of $340.
And we're done. But before you go, make sure you can draw a diagram showing how demand and supply interact to determine market equilibrium. Draw a diagram and explain how shifting the demand and supply curves to produce a new market equilibrium, with reference to excess demand, shortage, and excess supply, surplus. Analyze the price mechanism with respect to its functions. Explain the meaning of producer/consumer surplus and social/community surplus. Draw a diagram showing consumer and producer surplus, social/community surplus, maximized at competitive market equilibrium. Explain the conditions for achievement of allocative efficiency at competitive market equilibrium. And for HL students, calculate consumer and producer surplus from a diagram. And as always, if you have any questions for me, feel free to leave them in the comments. That's all for now. Big Kev, out.